This chapter introduces the aggregate demand, aggregate supply model, a variable price model in which it is possible to simultaneously analyze changes in real GDP and the price level. The chapter explains the shapes of the aggregate demand and aggregate supply curves and the forces causing them to shift, causing changes in equilibrium levels of prices and real GDP. Finally, the chapter analyzes the effects of shifts in the aggregate demand and aggregate supply curves on the price level and size of real GDP. The tools learned in this chapter are important to determine appropriate fiscal and monetary policies to stabilize the economy. The aggregate demand aggregate supply model will appear in many multiple choice questions on the AP macro exam. This is also the model that students are generally asked to use for free response questions on the AP macro exam. So it's critically important for you to understand the basics in this chapter because the model will be used repeatedly for discussion of unemployment, inflation, and economic growth in later chapters. This is a variable price, variable output model, unlike the previous chapter that was an immediate short-run model where prices were assumed fixed. As you will see, this chapter's model can distinguish between the immediate short run, and the long run. Aggregate demand is a schedule curve that shows the various amounts of real domestic output that domestic and foreign buyers desire to purchase at each possible price level. The aggregate demand curve shows an inverse relationship between price level and real domestic output. Not all unlike your typical demand that we learned in earlier chapters, with the same shape and inverse relationship, just with two different variables. The explanation of the inverse relationship, however, is not the same as for demand for a single product, which centered on substitution and income effects. When we're talking about all products, there's no substitution for all products, and that's what aggregate demand is discussing. Income effect also doesn't apply in the aggregate case, since income now varies with aggregate output. The explanation of the inverse relationship between price level and real output in aggregate demand are explained by three effects. The first is the real balances effect. When price level falls, the purchasing power of existing financial balances rises, which can increase spending. The second is the interest rate effect. A decline in price level means lower interest rates that can increase levels of certain types of spending. And the third is the foreign purchases effect. When price level falls, other things being equal, U.S. prices will fall relative to foreign prices, which will tend to increase spending on U.S. exports and also decrease import spending in favor of U.S. products that compete with imports, similar to the substitution effect. Both effects cause an increase in spending for American products. This figure depicts the aggregate demand curve. The downsloping aggregate demand curve, AD, indicates an inverse or negative relationship between the price level and the amount of real output purchased. Determinants of aggregate demand are the other things besides price level that can cause a shift or a change in demand. Effects of the following determinants are discussed in more detail in the slides to come. The first is changes in consumer spending, which can be caused by changes in several factors: consumer wealth, consumer expectations, household debt, and taxes. The second is changes in investment spending, which can be caused by changes in several factors like interest rates. Another factor is expected returns, which are a function of expected future business conditions, technology, degree of excess capacity, and business taxes, all of which we discussed in the previous chapter. Changes in government spending can impact it, as well as changes in net export spending unrelated to price level, which may be caused by changes in other factors such as national incomes abroad and exchange rates. This figure shows changes in aggregate demand. A change in one or more of the listed determinants of aggregate demand will shift the aggregate demand curve. The rightward shift from AD1 to AD2 represents an increase in aggregate demand. The leftward shift from AD1 to AD3 shows a decrease in aggregate demand. The vertical distances between AD1 and the dashed lines represent the initial changes in spending, and through the multiplier effect, That spending produces the full shift of the curves. Consumer wealth is the difference between household assets, homes and stocks and bonds, and liabilities, loans and credit cards. The value of the assets can change, and the consumer will react by spending more as asset values increase and spending less as asset values decrease. Households can borrow in order to spend more, which increases aggregate demand. And if the household reduces spending in order to pay off household debt, aggregate demand decreases. Expectations of future higher incomes or higher prices will increase current household spending and aggregate demand, while expectations of lower household spending or lower prices will decrease aggregate demand. A reduction in personal income taxes increases disposable income and thus increases spending by the household and increasing aggregate demand, whereas an increase in taxes will decrease our disposable income, which decreases household spending, which in turn decreases aggregate demand. Investment spending is spending on capital goods. Increases in investment spending can increase aggregate demand, whereas decreases will decrease aggregate demand. As real interest rates increase, the cost of borrowing increases and subsequently less will be borrowed, resulting in less money being spent, as we saw in Chapter 27. That would reduce aggregate demand. On the other hand, a decrease in real interest rates will increase borrowing and subsequently investment spending will increase aggregate demand. If business owners and managers are optimistic about future expected returns, then they're going to spend more now to try to produce more, which would increase aggregate demand. And if expected returns are less than favorable, they will spend less now, reducing aggregate demand. That's simply going back to expected rate of return. Now, new technologies enhance future expected returns and thus motivate businesses to spend money on the new technology, increasing aggregate demand. If excess capacity increases, businesses will decrease current spending, decreasing aggregate demand. And if excess capacity decreases, businesses will increase spending in order to expand their operations and increase aggregate demand. And finally, an increase in business taxes will decrease the amount of after-tax income for businesses, so they're going to reduce the amount of spending businesses are capable of, which reduces aggregate demand. A decrease in business taxes has the opposite effect on aggregate demand. Other things equal, if government spending increases, aggregate demand increases. An example of government spending is more or less transportation projects. If government spending decreases, aggregate demand decreases. An example of this could be military spending. Finally is net exports. If net export spending rises, aggregate demand rises. If net export spending declines, aggregate demand declines. As the national incomes of trading partners of the U.S. increase, they are more able to purchase U.S.-produced goods and services, which increases aggregate demand. But if foreign nations' income declines, the opposite is going to occur. Exchange rates also impact it. If the dollar depreciates relative to another country's currency, then aggregate demand increases. Depreciation of the dollar encourages U.S. exports since U.S. products become less expensive as foreign buyers can obtain more dollars for their currency. Conversely, dollar depreciation discourages import buying in the U.S. because our dollars can't be exchanged for as much foreign currency, so we continue to buy products made at home. Now, aggregate demand can decrease through changes in currency and exchange rates if the U.S. dollar appreciates relative to another country's currency. The currency appreciation of the dollar discourages U.S. exports because now U.S. goods are relatively more expensive than before since it takes more of the foreign currency to buy the U.S. dollar. This will also encourage more import spending since the U.S. dollar can buy more of another nation's currency than before. Net exports will decline, which reduces aggregate demand. Aggregate supply is a schedule or curve showing the level of real domestic output available at each possible price level. The relationship is determined on the basis of whether input prices and output prices are fixed or flexible. In the immediate short run, both input prices and output prices are fixed. The input prices are fixed by contractual agreements such as labor contracts. Output prices may be fixed as a result of issuance of catalogs or price lists that are in effect for a stated period of time. In the short run, input prices are fixed, but output prices are variable, and in the long run, input prices and output prices can vary. The figure illustrates aggregate supply in the immediate short run. In the immediate short run, the aggregate supply curve, ASISR, is horizontal at the economy's current price level, P1. With output prices fixed, firms collectively supply the level of output that is demanded at those prices. This figure shows the aggregate supply curve in the short run. The upsloping aggregate supply curve, AS, indicates a direct or positive relationship between the price level and the amount of real output that firms will offer for sale. The AS curve is relatively flat below the full employment output because unemployed resources and unused capacity allow firms to respond to price level rises with larger increases in real output. It is relatively steep beyond the full employment output because resource shortages and capacity limitations make it difficult to expand real output as the price level rises. Aggregate supply slopes upward because the input price is fixed. Rising prices increase real profits, and declining prices result in decreases in real profits. This figure reflects aggregate supply in the long run. The long-run aggregate supply curve, ASLR, is vertical at the full employment level of real GDP, QF. Because in the long run, wages and other input prices rise and fall to match changes in the price level. So price level changes do not affect firms' profits, and thus they create no incentive for firms to alter their output. In the long run, the economy will produce the full employment output level no matter what the price level is, because profits always adjust to give firms exactly the right profit incentive to produce exactly the full employment output level. Determinants of aggregate supply are the other things besides price level that can cause changes or shifts in the aggregate supply at each price level. Changes that reduce per unit production costs shift the aggregate supply curve to the right. Changes that increase per unit production costs shift aggregate supply to the left. For the rest of the chapter, when we talk about the aggregate supply curve, we're going to refer to the short run curve, unless otherwise noted. And this will also be the curve that you use on your AP test, the short run. This figure illustrates changes in aggregate supply. A change in one or more of the aggregate supply determinants listed on the next slide will shift the aggregate supply curve. The rightward shift of the aggregate supply curve from AS1 to AS2 represents an increase in aggregate supply. The leftward shift of the curve from AS1 to AS3 shows a decrease in aggregate supply. A change in input prices, either domestic or imported resource prices, will impact aggregate supply. Domestic resource prices, like labor market, experiences an increase in supply which decreases wages, reduces per unit production costs, and increases aggregate supply. If the labor market saw a decrease in the supply of labor, say due to older workers retiring, wages would increase, per unit production costs would increase, and the aggregate supply would shift left. Capital and land prices affect aggregate supply the same way as labor costs. If their prices fall, aggregate supply shifts to the right. If their prices increase, then aggregate supply shifts left. Prices of imported resources. As imported resources add to domestic supplies and act to reduce per unit production costs, which increase aggregate supply. An increase in the price of imported resources, such as oil, acts to increase per unit production costs, which decreases aggregate supply. Exchange rate fluctuations can cause changes in per unit costs too. If the dollar appreciates, U.S. producers will be able to purchase more imported resources more cheaply, reducing per unit production costs and increasing aggregate supply. If the dollar depreciates, imported resources become more costly, increasing per unit production costs, which decreases aggregate supply. Changes in productivity, shown by productivity equals real output divided by input, can cause changes in per unit production costs. Production cost per unit equals the total input cost divided by units of output. If productivity rises, unit production costs will fall. This can shift aggregate supply to the right and lower prices. The reverse is true when productivity falls. Productivity improvement is very important in business efforts to reduce costs. A change in the legal institutional environment can change per unit production costs and change aggregate supply. Higher business taxes increase costs for businesses and reduce short-run aggregate supply. Business subsidies lower production costs and increase short-run aggregate supply. It is costly for businesses to comply with government regulation. More regulation increases per unit production costs for businesses and shifts the aggregate supply curve to the left. Deregulation will reduce per unit production costs and shifts the aggregate supply rightward. This figure shows the equilibrium price level and equilibrium real GDP. You'll notice it looks real similar to when we did the supply and demand curves in chapters 1 and 2. The intersection of the aggregate demand curve and aggregate supply curve determines the economy's equilibrium price level. At the equilibrium price level of 100, the $510 billion of real output demanded matches the $510 billion of real output supplied. So the equilibrium GDP is $510 billion. This figure shows an increase in aggregate demand that causes demand pull inflation. The increase in aggregate demand from 81 to 82 causes demand pull inflation, shown as the rise in the price level from P1 to P2. It also causes an inflationary GDP gap of Q1 minus QF. The rise in the price level reduces the size of the multiplier effect. If the price level had remained at P1, the increase in aggregate demand from 81 to 82 would increase output from QF to Q2, and the multiplier would have been at full strength. But because of the increase in the price level, real output increases only from QF to Q1, and the multiplier effect is reduced. This figure shows a decrease in aggregate demand that causes a recession. If the price level is downwardly inflexible at P1, a decline of aggregate demand from 81 to 82 will move the economy leftward from A to B along the horizontal broken line segment and reduce real GDP from QF to Q1. Idle production capacity, cyclical unemployment, and a recessionary GDP gap of Q1 minus QF will result. If the price level were flexible downward, the decline in aggregate demand would move the economy depicted from A to C instead of from A to B. If aggregate demand decreases, recession and cyclical unemployment may result. Prices don't fall easily. Fear of price wars keeps prices from being reduced. Businesses fear that if they decrease their price, their rivals may decrease their price even more, which would cause a price war. Successfully deeper and deeper price cuts which result in reduced profits for all the firms. Menu costs discourage repeated price changes, and menu costs are the costs businesses incur from printing new price lists or catalogs, repricing inventory, and communicating new prices to customers. Firms may wait and see if the decline in aggregate demand is permanent before they make any changes. Large parts of the workforce are under wage contracts that are not flexible. Therefore, businesses can't afford to reduce the price of their products. Employers are reluctant to cut wages because of the impact on employee morale, effort, and productivity. Employers seek to pay efficiency wages, wages that maximize work effort and productivity, minimizing costs. The minimum wage law is a legal minimum wage for low-skilled labor. Firms that pay minimum wages cannot reduce them when aggregate demand declines. This figure reflects a decrease in aggregate supply that causes cost push inflation. A leftward shift of aggregate supply from AS1 to AS2 raises the price level from P1 to P2 and produces cost push inflation. Real output declines and a recessionary GDP gap of Q1 minus QF occurs. This figure illustrates growth, full employment, and a relatively price stability. Normally, an increase in aggregate demand from 81 to 82 would move the economy from A to B along AS1. Real output would expand to Q2 and inflation would result, P1 to P3. But in the late 1990s, significant increases in productivity shifted the aggregate supply curve, as shown by AS1 to AS2. The economy moved from A to C rather than from A to B. It experienced strong economic growth, full employment, and only very mild inflation, P1 to P2, before receding in March of 2001. Has the impact of oil prices diminished? Well, in the mid and late 1970s, oil price shocks caused cost-push inflation, rising unemployment, and a negative GDP gap, what we know as stagflation. In the late 1980s and through most of the 90s, oil prices fell, prompting OPEC, along with Mexico, Norway, and Russia, to restrict output and raise prices, up to $34 a barrel in March of 2000. This price shock did not cause the cost-push inflation and recessionary conditions as with previous shocks. In 2005, conflict in the Middle East combined with rapidly rising demand for oil in India and China pushed oil prices above $60 a barrel. U.S. inflation rose in 2005, but not core inflation. A number of reasons explain why oil price shocks have had less of an impact. Low production costs from productivity increases have offset inflationary pressure from oil price increases. The amount of gas and oil used to produce each dollar of output has declined by about 50% since 1970. Federal Reserve monetary policy helped keep oil prices increases from becoming generalized as well.